Good evening, investors. Welcome back with me, Madhaveshwari, on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia experienced a powerful relief rally during mid-afternoon trade today, with the benchmark index surging over 24 points. This sharp recovery follows a period of intense geopolitical anxiety as sentiment shifted dramatically after US President Donald Trump signaled that the conflict with Iran could conclude very soon. At 3 p.m., the FBM KLCI climbed 24.29 points, 2,698.46, reclaiming much of the ground lost during Monday's regional sell-off. The broad-based rally saw gainers outnumbering losers 792 to 398, with total market turnover reaching 2.42 billion units, valued at 2.17 billion ringgit. Leading the charge were the financial services and utilities sector, which benefited from a risk-on shift as global oil prices began to retreat from recent peaks. Maybank jumped 22 cents to 11 ringgit 68 cents, while Tenaga Nasional, a bellwether for the utilities sector, likewise climbed 22 cents to reach 14 ringgit 6 cents. In the broader market, aviation stocks emerged as the primary beneficiaries of the cooling tensions. AirAsia X surged 18 cents to 1 ringgit 28 cents, while its parent company Capital A advanced 3.5 cents to 44.5 cents. The surge reflects investor optimism that a swift resolution to the conflict would prevent long-term flight rerouting and stabilize jet fuel costs, which had spiked over the weekend. Conversely, the war premium that had boosted commodity-related stocks began to evaporate. The energy index dropped 26.12 points as Brent crude fell over 5% to $94.45 per barrel. Hibiscus petroleum fell 26 cents to 2 ringgit 13 cents, while Hang Yun refining shed 32 cents to 1 ringgit 58 cents, both seeing their earlier gains erased. The plantation index also retreated as United Plantations slid 88 cents to 30 ringgit 82 cents amid expectations that a de-escalation would lead a normalization of crude palm oil prices. On the index board, the positive momentum was felt across all tiers. The FBM Mass Index rose 167.68 points and the FBM A's Index increased 107.50 points to 4,314.23. Analysts suggest that while today's rally provides a much-needed buffer, volatility may stay elevated as participants assess the potential implications for global energy supply, particularly as the market awaits further confirmation of diplomatic breakthroughs in the Middle East. Now for some local news updates. Bursa Malaysia has suspended intraday short selling for 3 prominent oil and gas companies for the remainder of the day after their share prices experienced sharp declines exceeding the exchange's 15% threshold. The affected counties include Hang Yun Refining Company, Berhad, Petra Energy Berhad, and Hibiscus Petroleum Berhad. This suspension was triggered during the morning session as selling pressure intensified. By 11:15 a.m., Hang Yun Refining had dropped as much as 22 cents to 1 ringgit 68 cents, while Hibiscus Petroleum shed 19 cents to 2 ringgit 39 cents. Petra Energy saw a significant intra-morning slide, dropping as much as 18 cents to 65.5 cents around 10 a.m. before settling slightly higher at 74 cents. Under Bursa's rules, IDSs for these securities will only resume on Wednesday, March 11 at 8:30 a.m. The sharp moves in the energy sector come amid high-stakes geopolitical shifts, while Asian markets suffered a regional sell-off yesterday due to spiking crude prices. Bursa Malaysia showed signs of recovery today. This follows a pivot in sentiment from Wall Street after US President Donald Trump characterized the ongoing conflict with Iran as a short-term excursion. Speaking from his Doral Golf Club, Miami, President Trump suggested the war could be over very soon, claiming that US and Israeli forces has already decimated Iran's military and naval infrastructure. These reassurances immediately cooled energy markets, with Brent crude falling 5.01% to $94.45 per barrel by midday Tuesday. The drop in oil prices has had a double-edged effect on the local market. While it provides relief for broader inflation concerns and transportation costs, it has triggered profit-taking and margin pressure on the ONG heavyweights that had rallied during the initial conflict surge. Analysts at Apex Research noted that volatility may stay elevated as participants assess the potential implications for global energy supply, though any concrete signs of de-escalation are expected to stabilize risk assets in the coming days. Still on economic news, the Federation of Malaysia Manufacturers has formally proposed to establishment of an ad hoc export crisis response task force to mitigate the severe operational challenges arising from the escalation Iran-US-Israel conflict. FMM President Jacob Lee Chao-Kok emphasized today that a coordinated government-industry mechanism is now critical to protect Malaysia's manufacturing exports as tensions choke the Strait of Hormuz and major maritime corridors. With more than 90% of Malaysia's trade transported by the sea, the manufacturing sector is facing direct exposure to volatile shipping routes. Lee noted that major shipping lines have already introduced emergency freight increases for cargo moving to and from Gulf ports, while war risk insurance premiums have surged. He also cautioned that the current congestion at Port Klang could worsen significantly if these routes remain compromised. Lee stated that stable and reliable maritime logistics remain critical to sustain export performance and industrial production. Drawing parallels to the 2024 Red Sea crisis, FMM warned that freight rates on affected routes previously tripled within weeks, while diversions extended transit times by up to 14 days. Malaysian manufacturers exporting to Gulf markets now face a similar reality of higher freight costs, tighter vessel capacity, and uncertainty over delivery schedules. While the Gulf Cooperation Council countries are not Malaysia's largest export destination, the region serves as a vital transshipment hub for goods destined for Africa, Central Asia, and Europe. The proposed task force, which Lee suggests should be chaired by Ministry of Investment, Trade and Industry, would provide real-time market intelligence on freight rates and logistics developments. By bringing together the Ministry of Transport, Port Authorities and Bank Negara, the task force aims to introduce support measures for exporters facing cargo abandonment or prohibitive costs. Up next, we have some corporate updates. Malaysia's manufacturing sector started the year on a high note, with sales value rising 7.1% year-on-year to 169.4 billion ringgit in January 2026. Data from the Department of Statistics Malaysia reveals an acceleration from the 6.4% growth recorded in December 2025. Signaling a robust industrial momentum despite shifting global economic conditions. Chief Statistician Dato Sri Dr. Muhammad Uzair Mahidin attributed the performance primarily to the electrical and electronics subsector, which surged 15.6%. Dr. Muhammad Uzair noted that the growth was further supported by the food, beverages and tobacco and the non-metallic mineral products, basic metal and fabricated metal products subsectors. Export-oriented industries, which command over 70% of total sales, saw a 7.2% improvement, largely fueled by 17.9% jump in computer, electronics and optical products. The domestic-oriented segment also showed resilience, expanding 6.9% in January compared to 5.6% in the previous month. This domestic uplift was anchored by an 11.6% growth in food processing products and steady gains in basic metal manufacturing. On a month-on-month basis, the overall manufacturing sales value edged up by 0.5% from the 168.6 billion ringgit recorded in December. Employment within the sector remains a key pillar of the economy, with the workforce growing 1.3% to reach 2.4 million employees in January. This hiring trend was most visible in the food and beverage and E&E sectors. While total salaries and wages expanded 2.8% year-on-year, 8.71 billion ringgit, they saw a seasonal 4.4% decline compared to the preceding month. Dr. Muhammad Uzair added that the sales value per employee registered at 69,779 ringgit, marking a 5.7% increase and reflecting higher productivity across the industrial landscape. And finally, wrapping it up with some corporate updates. EP Manufacturing Berhad has officially commenced the local assembly of the MG-S5 electric vehicle, and its facility is HiCom Go, signaling a major step in Malacca's evolution into a regional green technology hub. The company aims to assemble between 120 and 180 units per month for the domestic market, with total production projected to reach up to 2,000 units this year. Malacca Chief Minister Dato Sri Abdul Rauf Yusof, who officiated the launch, highlighted the move marks the state's formal entry into the regional electric mobility supply chain. He stated that today's launch not only introduces a new EV but also marks Malacca's entry into the regional electric mobility supply chain, highlighting the state's growing role in the country's transition towards the green mobility. The Chief Minister added that the facility's success proves Malacca possesses the skilled workforce and sufficient resources required to handle advanced automotive manufacturing. The transition to completely knocked down assembly is a strategic milestone for SAIC Motor Malaysia and the brand owner of MG. By localizing production, the company aims to bring its products closer to Malaysian consumers while bolstering the local vendor ecosystem. Imori Q, Managing Director of SAIC Motor Malaysia, stated that the assembly of the MG-S5 EV represents a significant milestone for MG in Malaysia and reflects their long-term commitment to localization and strengthening Malaysia's role in the regional EV ecosystem. The MG-S5 EV, which features a rear-wheel drive platform, is the first electric vehicle to be locally assembled at the EPMB Malacca plant. Beyond vehicle assembly, EPMB and SAIC Motor are collaborating with local suppliers to accelerate the localization of critical components, including battery pack assembly. This initiative aligns with Malaysia's broader goal of becoming a regional automotive hub, leveraging its strategic location within ASEAN to attract further high-tech investments in the EV sector. Well, that's a wrap for Closing Bell Updates with me, Madhaveshwari. Thank you, investors. We shall catch up in the next session. Goodbye.